I think if you look at the macro climate, in the middle of 2020, Jerome Powell said, we're not even thinking about it raising interest rates until the year 2024. So then we had the Fed basically buying $120 billion a month worth of bonds, and interest rates pegged at zero. And then everybody said, well, there's inflation, but the politicians said there's no inflation for a year, even though we had massive hyperinflation in assets for a year. But they denied the inflation. And this is a result of them just tracking the CPI index. Because, as we talked about before, CPI is one out of many inflation metrics you could measure. So they track the one that is going to have the longest lag. Because if you lock people down for a year and they can't take a cruise and they can't go to a concert and they can't go to a restaurant, then they can't consume. So if you can't consume consumer products, you can't, by definition, you can't have inflation in those products. There's no demand. So the later, there's a lag in some demands, like it takes you 6 months to buy a house. So there's a slight lag in house prices. There's no lag at all in asset prices, like bonds hyperinflated in minutes, equities hyperinflated. The Amazon price, hyperinflated, it went to $3,400 from $1,800, like in a short period of time. So I think the politicians, from a monetary point of view, they looked at the wrong indicator and they waited and they waited. And they still only had raised interest rates like 25 basis points as of a couple of days ago, right? And so now we've gone from there is no inflation and we're not even thinking about doing anything, to, oh my, there's tons of inflation and we have to go faster. And I think like this morning, these 8.5% inflation number came out, and it was higher than people expected. And then the markets think, oh, well, they'll have to even raise interest rates faster. So we went from not even thinking about to constantly, continually thinking about and going faster. And it's like, if you're putting 120 billion in bond purchases in the market every month, that's like kind of it's pumping heroin or morphine into the patient. So now we take the patient off the morphine and we tell them that we're jacking the interest rates through the roof. And of course, that's a massive contraction, like a withdrawal. I think that this is first order, second derivative type stuff. We're still in an inflationary environment, and they're not really tightening to the extent they need to stop that. Like the theoretical interest rate you would tighten to stop 8.5% true inflation is 9%, right? So if this was Paul Volcker, he would have raised interest rates overnight to 9%. And what we did is we raised interest rates 25 basis points or to 0.75% and talked about maybe moving it up another 1 or 2%. So in a year and a half, when the interest rate is 2.5%, it will still be less than 8.5%. And 8.5% is a hedonically adjusted number. And I think I saw some calculations. They said if they used the 1980 methodology, it would have been 15%. Mm-hmm. It would have been double or something. So the neutral interest rate, if you actually had a conservative bank, would be 16% interest rate in the US dollar. We're not there. We're not getting there. We're not going anywhere near there. And every prescription I've seen is inflationary. So I think that they're making a lot of noise. It means the traders are trading. But let's like minute by minute, hour by hour, day by day, you kind of have to reduce your IQ by 50 points. Like you can't be too smart because you have to kind of, dumb yourself down to trade with traders. This is why I don't trade with traders, because the opposite of the rational is the profitable, or you have to do the double opposite of the rational to trade with traders. So I don't think that makes sense. But in October of 2020, Bitcoin was like 12,000. NASDAQ was 11, I think Bitcoin was 12,800 or something, or maybe 11,800. And NASDAQ was like 11,000 and change. And gold was higher than it is now.
Mm-hmm.
And if you roll the clock forward 24 months, Bitcoin is up by not quite a factor of 3, but factor of 2.75. Gold is down. NASDAQ is sideways. And the rest is sound and fury. If you look back 4 years, you see the same pattern. You look back 8 years, you see the same pattern. So if you're a trader, you go through this perverse thing of, oh, they're going to raise interest rates 75 basis points or 50 basis points, or they said they wouldn't raise it. When they weren't going to raise interest rates 75 basis points, the market rallies. When inflation is worse than you expected, the market tanks. But if inflation is worse than you expected, you really ought to be buying the inflation hedge, which is Bitcoin. But you're not, and that's because people that don't really understand how Bitcoin works are just trading it based upon a back-tested model. So the back-tested model says it's correlated to risk assets with higher volatility. So therefore, if I think risk is going to trade off, I should trade it. Again, they're traders. The traders are in a tug of war with the technocrats. The technocrats are bearish. They're afraid. The traders are mercenary, right? They'll just make a buck. The maximalists are already all in. We're dollar cost averaging. So we're kind of along for the ride. And the Fed's going to control the mood of the traders and the technocrats in the near term. And the Fed's jerking everybody around. But in time, if the economy actually truly compresses, someone will come back and they'll lighten up some of the monetary policy. We'll go the other direction. I think the big lesson is that all of these cryptos, other than Bitcoin, are securities. And if they're securities, that means that there are management teams and there are policies. And the question is, what's the reserve backing the coin? And what are the policies backing the coin, right? And so I can't really tell you what the reserves were or are with UST, and I can't tell you what the policies were, right? Because there aren't 200 pages of SEC filings that explain to you that, right? No one in the world knows what the reserves are for Tether. You kind of have a vague idea, but you don't really know. And what are the policies? You don't really know. You know a little bit more, but you still don't really know what are the reserves of the other stable coins. So the whole point of the regulators like Gary Gensler is their securities. There should be full disclosures. The disclosures require armies of lawyers and accountants, right? They slow things down. You can't go fast and break things when you're dealing with that much money. You have to actually disclose everything. And people ought to know what they're investing in. So if you buy MicroStrategy stock, you can read all of our bond terms. They're published. We publish the terms of the Silvergate loan, the terms of the converts, the terms of the junk bond. You can read them, right? You can read the financial statements of the company. You can read about who governs the company, right? You know who the shareholders of the company are. Every single time any material thing changes, right, via an 8K. That's the way that securities work when you're responsible for large sums of other people's money. I think that the crypto industry is immature. It's going to grow up, right? It needs to. We're crossing the chasm from entrepreneurial driven entities to institutional entities. And one thing that institutions do is they have very sophisticated systems for providing transparency, and they have like 3 attorneys to figure out when you write the sentence saying exactly who does what when, how do you punctuate it, and is there any confusion? If there is some confusion, that's a problem. That's why people obsess over these things.